Most people have no idea that for the first time in human history, silver became cheap not because it lost value, but because someone needed it to look worthless. For thousands of years, the world understood one simple fact. Silver was not a secondary metal. It was money. It was technology. It was power. Empires rose and fell depending on how much of it they controlled. But something extraordinary happened in the 20th century. Something unprecedented. Silver didn't just get cheaper. It was pushed down deliberately and systematically until an entire civilization forgot what this metal actually represents. The shift began quietly. As modern finance evolved, governments stopped using silver as a monetary base. The metal was removed from coins, removed from reserves, and slowly pushed out of the public consciousness. Not because it had become useless, but because a monetary system built on paper required commodities to be stable, predictable, and above all, cheap. Silver, with its dual identity as both money and industrial fuel, became a threat to the new order. Once silver lost its official monetary role, the illusion took hold. People began believing that industrial metals should be inexpensive, that silver was abundant, that it was poor man's gold. History was erased, and a new narrative was engineered. If it doesn't back currencies, it can't be valuable. But the truth is sharper than ever. Silver didn't become cheap. It was buried, its true price suppressed under decades of financial engineering. As industries exploded, electronics, medicine, photovoltaics, silver quietly became one of the most consumed resources on Earth. More consumed than mined, more needed than ever. Yet the market price did not reflect this reality. It reflected something else entirely, a financial architecture designed to mask scarcity by flooding the world with paper promises. 50 years ago, the price of silver still had a relationship with supply and demand. But year by year, that relationship weakened. New financial instruments emerged, allowing institutions to sell what they did not have. The physical market shrank. The paper market grew. And the disconnect grew so massive that today, the global price of silver is determined mostly by contracts representing metal that does not even exist. This is how manipulation begins. Not through dramatic conspiracies, but through slow normalization. Through incentives. Through silence. The world didn't lose the real price of silver overnight. It was pushed away from it, inch by inch, until people forgot that silver is one of the few materials absolutely essential for modern life and absolutely irreplaceable. And now the illusion is cracking. Because for the first time in 50 years, physical silver is becoming harder to source, harder to mine, and harder to hide behind financial smoke screens. The real price never disappeared. It has been waiting beneath the surface, and the pressure is building. There is a moment in financial history almost no one talks about. The moment silver stopped being a physical market and became a story written on paper. From that point on, the price you saw was no longer the price of silver. It was the price of an illusion. When the comics futures market expanded in the late 20th century, it introduced a new kind of power, the ability to trade silver that didn't exist. For centuries, the value of silver was dictated by something simple and obvious: how much metal was actually available. Mines, vaults, and physical supply determined the price. You could not sell what you did not have. You could not promise what was not in your vault. Reality, not theory, controlled the market. But with the rise of futures and derivatives, the financial world created a parallel universe where silver could be sold endlessly on paper, detached from the limits of physical supply. Contracts multiplied far beyond the amount of real metal in existence. And with each new layer of abstraction, the market became less about silver and more about controlling its price. The shift was subtle, but devastating. Instead of 1 ounce of silver representing 1 ounce of value, institutions could now sell 100 ounces, 200 ounces, even 400 ounces of virtual silver for every physical ounce available. The market became a pyramid made of promises. And because these promises were cheaper to create than real metal, they overwhelmed the physical market until the true price was drowned beneath waves of synthetic supply. Imagine a world where you could mint gold bars out of thin air and sell them as if they were real. The price of gold would collapse instantly. And that is exactly what happened to silver. This wasn't accidental. Paper markets gave governments and major banks a tool they desperately wanted: price control. If silver rose too quickly, they could dump thousands of paper contracts into the market without delivering a single ounce. If industries needed stability, they could create it artificially. The financial system gained the ability to smooth out volatility by replacing scarcity with illusion. And it worked for 50 years. The public accepted the paper price as the real price. Investors stopped demanding physical delivery. Industries enjoyed cheap input costs. And banks profited from infinite leverage. But there was a hidden cost. Over time, the paper system detached so far from reality that today, the amount of silver promised on exchanges exceeds physical supply by hundreds of times. This creates a paradox. The market price is low, yet physical silver is disappearing from vaults at a pace faster than ever recorded. The disconnect is no longer a crack. It's a fault line. The birth of paper silver solved a problem for the financial world, but in doing so, it created a new one, a system that collapses the moment people stop trusting paper and start demanding metal. Because a paper promise can be printed endlessly, but silver cannot. And the day these two facts collide, the fiction ends. While the world believed silver was cheap and abundant, one institution quietly did the opposite of everyone else. It accumulated more silver than any government, empire, or corporation in recorded history. And almost nobody realized it was happening. When the price of silver was being artificially suppressed through paper contracts, something extraordinary took place behind the scenes. The largest bank in the United States, J.P. Morgan, began acquiring physical silver with a strategy so deliberate, so methodical, that it reshaped the entire landscape of the global silver market. It started subtly, under the cover of market chaos. Between 2011 and 2013, silver experienced extreme volatility, violent spikes followed by equally violent crashes. Retail investors panicked. Funds liquidated positions. Miners struggled. The average person saw chaos. But J.P. Morgan saw opportunity. They began taking physical delivery of silver from futures contracts at a scale no institution had ever done. As other participants fled the market, J.P. Morgan quietly became the biggest buyer. They accumulated silver from ETFs, from private sales, from refiners, from wholesalers, absorbing supply that the world no longer valued. By the mid-2010s, analysts began noticing something strange. The COMEX warehouse controlled by J.P. Morgan was swelling with metal. Year after year, shipment after shipment, the bank kept accumulating. No announcements. No explanations. No publicity. Just silent acquisition. By the time the world realized what was happening, J.P. Morgan had amassed an estimated 1 billion ounces of silver, a stockpile unmatched in human history. More than the U.S. government. More than any sovereign reserve. More than entire nations combined. And this wasn't a coincidence. The same institution accused and fined for manipulating the precious metals market was simultaneously building the largest physical silver hoard ever seen. The logic is inescapable. If you know a market is suppressed, and you know suppression cannot last forever, the smartest strategy in the world is simple. Buy everything you can while it's cheap. J.P. Morgan's silver accumulation wasn't speculation. It was insurance. It was preparation. It was positioning for a future where physical metal becomes the only thing that matters. When the paper system fails, when supply contracts, when industries panic, when governments scramble to secure resources. If silver were truly worthless, J.P. Morgan wouldn't have spent more than a decade acquiring it. If silver were truly abundant, they wouldn't have outbid entire nations. If silver's price reflected reality, there would be no reason for secrecy. The bank that sits at the center of the global financial system knows something the public is only beginning to understand. The era of cheap silver is ending. 1 billion ounces is not a trade. It is a statement. Because when the world's biggest bank prepares for the revaluation of a metal the world thinks is insignificant, that metal is no longer insignificant. It is a powder keg, and J.P. Morgan is sitting on top of it. If silver were ever allowed to reach its real price, the global financial system would experience a shockwave so powerful it could destabilize currencies, bankrupt institutions, and exposed decades of hidden fragility. That is why the price was never just a market variable. It was a pressure point, too dangerous to release. Silver is not just a metal. It is a foundation, a silent pillar holding up parts of the economy most people never think about. And if the value of that pillar suddenly multiplied, everything built on top of it would start to crack. To understand why silver's price had to be suppressed, you have to see the world through the eyes of central banks, governments, and multinational financial institutions. From their perspective, silver is not a commodity. It is a potential trigger. Because silver exists in a rare space where monetary history, industry, and finance collide. If silver rises dramatically, the dollar's credibility is questioned. For over a century, the dollar maintained dominance partly by suppressing real stores of value. When gold and silver surge, it signals distrust in fiat money. A soaring silver price is not an economic event. It is a political message. It tells the world the currency system is weakening. Industrial costs explode. Every sector that relies on silver, electronics, medicine, solar energy, aerospace, depends on stable, low prices. If silver 5 times or 10 times, the cost structure of global manufacturing fractures. Supply chains destabilize. Governments panic. Banks face catastrophic exposure. The paper silver market is built on leverage. Institutions have sold claims on silver they do not possess. If silver rises quickly, fulfilling those contracts becomes mathematically impossible. A squeeze would annihilate the derivatives market and reveal that most silver never existed. Investment flows shift away from traditional markets. A genuine silver bull market drains liquidity from stocks, bonds, and currencies. Capital moves toward real assets. The financial machine hates that because it relies on capital staying inside the system, not flowing to physical commodities outside institutional control. And here is the deepest fear. A high silver price threatens the balance of geopolitical power. Nations with high technological demand but low natural silver reserves would become vulnerable. Energy transitions would slow. Military programs would weaken. Whoever controls silver controls a fundamental element of the future. So the suppression of silver wasn't random. It wasn't speculative. It wasn't merely an attempt to profit. It was preservation. A rising silver price exposes the weaknesses of the modern economic system: the debt, the derivatives, the inflation, the artificial stability. By keeping silver cheap, institutions maintained a buffer between illusion and reality. But buffers don't last forever. Every decade of suppression created more distortions. Paper markets multiplied. Physical supply dwindled. Industrial demand exploded. Government reserves vanished. Mining output stagnated. Eventually, the system reaches a point where suppression is no longer a strategy. It is a burden too heavy to maintain. The fear that once justified holding prices down now guarantees an even more violent revaluation when the facade breaks. Silver was not held down because it lacked value. It was held down because it has too much. For the first time in recorded history, humanity is consuming silver faster than it can be mined. And the gap is widening so violently that no price suppression, no financial engineering, no quiet intervention from banks can fix it. The industrial world is eating silver alive. Silver's greatest strength is also its greatest curse. It is the most conductive, most reflective, most versatile metal we have ever discovered. Nothing replaces it. Nothing competes with it. Nothing can perform the same functions at the same efficiency. And while investors argue over charts and ratios, industries do not argue. They consume. Relentlessly. Predictably. In ever-increasing quantities. The solar industry alone has become a black hole for silver. Modern photovoltaic cells require finely distributed silver paste to conduct current. There is no alternative. As governments push for renewable energy and corporations race to meet climate targets, demand doesn't simply rise. It explodes. 10 years ago, solar consumed a manageable portion of global silver supply. Today it devours more than a third. By 2030, it could consume half or more. And here is the part most people do not understand. Once silver is used in electronics or solar panels, it is effectively gone. It is not recycled. It is not retrieved. It vanishes into landfills, broken circuits, and discarded technology. We are burying silver faster than we are mining it. Electronics consume another massive share. Phones, laptops, cars, 5G systems. Every advancement in technology increases the amount of silver embedded into everyday life. Each device contains only a small amount, but billions of devices create a demand so enormous that mining companies cannot keep up. Medical industries rely on silver as well, not just in instruments, but in antimicrobial applications, coatings, wound care, and purifiers. The more advanced healthcare becomes, the more silver it requires. Then there is the rise of electric vehicles. Every EV uses more silver than a traditional combustion vehicle. And as governments worldwide push for full electrification, the demand curve steepens with terrifying speed. Now compare all of this to the supply curve. Global silver mining is declining. Not stagnating, declining. 7 consecutive years of falling production. Ore grades are deteriorating. New major discoveries are non-existent. Most silver is mined as a byproduct of other metals, meaning miners cannot simply increase production even if prices rise. They are limited by the output of lead, zinc, and copper mines. In other words, silver supply is structurally inflexible. It cannot respond to rising demand. It cannot scale with industrial expansion. It cannot be printed like money or synthesized in laboratories. This is not a normal commodity market. This is a countdown. Every year, more silver disappears forever into technology, energy, and medicine than the world can possibly replace. Reserves are shrinking. Vaults are draining. Recycling contributes almost nothing. The gap between supply and demand is no longer a cycle. It is a permanent feature of the modern world. Financial institutions can manipulate paper markets. They can control narratives. They can delay reality. But they cannot create silver. Industry does not care about COMEX charts. Solar panels do not care about futures contracts. Electronics manufacturers do not care about leveraged ETFs. They need physical metal, and the world is running out. The growing industrial appetite does not hint at a price explosion. It guarantees one. Because when factories, governments, and energy companies are forced to compete for the same limited pool of silver, there is only one direction the price can go, and it will not be a gentle rise. This is not speculation. It is physics, and physics always wins. Imagine a world where for every single ounce of silver that physically exists, 400 people believe they own it. That is not a hypothetical. That is the modern silver market. A system so disconnected from reality that its collapse is no longer a question of if, but when. The price you see on your screen is not the price of silver. It is the price of promises. Promises that cannot be kept. For decades, the financial system built a market structure where paper claims multiplied exponentially, drowning out the tiny pool of real metal backing them. Futures, derivatives, unallocated accounts, ETFs, fractional reserves, layer upon layer of financial engineering created the illusion of abundance. And because these instruments were cheaper, faster, and more profitable than dealing with physical silver, institutions leaned on them heavily. The result is staggering. Analysts estimate that for every ounce of physical silver available for immediate delivery, hundreds of ounces have been sold on paper. These contracts trade as if they are real, but behind the curtain, there is only a fraction of the metal required to fulfill them. This is the fault line beneath the entire precious metal system. As long as most investors are content to hold paper, the illusion holds. As long as industries accept settled contracts instead of physical supply, the gap stays hidden. As long as no one asks for delivery, the system works. But the moment people demand their silver, the system breaks. Why? Because silver is not like dollars or stocks or bonds. It cannot be created with keystrokes. It cannot be printed by a central bank. It must be mined, refined, and physically delivered. And there is not enough of it to honor even a fraction of outstanding claims. This creates a dangerous dynamic. The paper market suppresses the price, which increases industrial consumption, which reduces physical inventory, which widens the deficit, which increases the reliance on paper suppression. It is a self-reinforcing cycle spiraling toward collapse. Vault inventories prove it. Over the last 3 years, COMEX and London vaults have seen relentless withdrawals. Millions of ounces have disappeared into private hands, industrial use, and long-term storage. The available pool of deliverable silver is shrinking month after month. Yet the number of paper contracts continues to expand. It is the financial equivalent of selling tickets to a theater that burned down years ago. If even a small percentage of contract holders requested delivery, the market would face an immediate crisis. Exchanges would freeze. Banks would default. Settlement would be forced in cash, not metal. And the world would finally confront a truth hidden for half a century. The market never had the silver it claimed to have. This is why institutions fear any event that increases physical demand. A surge in industrial buying, a geopolitical shock, a renewable energy mandate, a loss of confidence in the dollar. All of these push the system closer to the event horizon. Because the moment physical demand exceeds the paper system's ability to compensate, paper prices become irrelevant. The real fight shifts to the physical market. And in the physical world, silver is scarce, essential, and vanishing fast. The disconnect between paper and physical silver is not a minor imbalance. It is a multi-decade deception that now threatens to unravel the entire structure of price discovery. And when reality finally overrides fiction, the repricing will not be gradual. It will be violent. Because a market built on 400 claims for every real ounce has only two possible outcomes. Either the claims disappear or the price explodes. One of those outcomes is inevitable, and the world is running out of time before it happens. Every manipulated market eventually reaches a moment where the lies can no longer hold. For silver, that moment is no longer a distant theoretical outcome. It is approaching with the force of inevitability. The system built to suppress silver is now the system ensuring its explosive revaluation. For 50 years, financial institutions controlled silver by controlling perception. They dictated the price through paper markets. They insulated industries from volatility. They maintained the illusion of abundance. But the foundation beneath that illusion is cracking, and the forces behind the coming break are not speculative. They are structural, physical, and unstoppable. The first force is geology. Silver ore grades are collapsing, mines are aging, and new discoveries are essentially non-existent. Unlike currencies or debt products, silver cannot be manufactured to meet demand. When the earth yields less, there is no lever financial institutions can pull to compensate. The second force is industrial consumption. Technology, solar energy, and electrification devour silver at a pace no market design can restrain. These industries do not care about COMEX futures or ETF flows. They need metal, not promises, and they need more of it every year. The third force is inventory depletion. Vaults around the world, once overflowing with silver, are bleeding metal. The COMEX registered category has shrunk. London vaults have seen massive drawdowns. Private investors increasingly demand physical delivery, not paper substitutes. Every ounce that leaves the system brings the breaking point closer. The fourth force is geopolitical fragmentation. As nations prioritize energy security and technological dominance, the importance of silver explodes. Countries with insufficient supply will face strategic vulnerabilities. Export bans, nationalization, and resource protectionism will become standard policy. When governments join the competition for silver, price control dies instantly. The fifth force is declining trust in financial intermediaries. After decades of opaque trading practices, spoofing, and manipulation scandals, the public no longer believes the paper price reflects reality. Each new revelation drives more investors toward physical metal. This shift in behavior is fatal for a system that relies on complacency. And then there is the force no one can stop: the failure of the paper-to-physical ratio. When the number of paper claims reaches a point where even a small percentage of buyers demand delivery, the entire structure implodes. Exchanges will settle in cash. Banks will face liquidity crises. Price discovery will migrate from digital platforms to physical marketplaces. And in the physical world, silver is scarce. Once the break begins, manipulation becomes impossible. You cannot suppress a price when no one will sell at that price. You cannot flood the market with paper when the world refuses to accept it. You cannot control a commodity when industries, governments, and investors are fighting over the last available ounces. The breaking point will not be a slow transition, it will be a phase change. A moment where silver stops behaving like a commodity and starts behaving like a strategic asset. Supply chains will reorganize around it. Prices will detach from historical ranges. The metal long treated as an afterthought will become a geopolitical instrument. And here is the final truth. Markets built on deception do not unwind gently. They snap. For decades, silver has been held underwater. Pressure built little by little, year after year. Now the pressure is reaching its limit. When manipulation fails, and it will, the spring launches upward with the force of everything that held it down. The world believes silver is just another metal. But very soon, it will understand the truth. Silver was never undervalued by accident. It was undervalued because the real price was too dangerous. And when that real price emerges, the world will not be ready.